Welcome back, focused learners. Today we're diving into another explainer where we absolutely strip away the noise and look directly at the hard data. We're breaking down a massive piece of financial news that's been literally flashing across screens everywhere lately, the recent disclosure of two major stock purchases by Nancy Pelosi. We're going to look closely at the actual filings, decode exactly what these companies do, and figure out what these moves really mean for the broader market. Let's get into it. Okay. Let's dive into this. The market has already reacted to this news in a huge way. I mean, one of these stocks jumped 8% in just a matter of hours after the disclosure dropped. But here's the real question we need to ask ourselves today. Should retail investors actually follow suit? Look, it's incredibly easy to get caught up in the hype when a high-profile figure makes a move, right? But is this a genuine signal, or is it just market noise that's going to fade by next week? To really understand the hype here, you just have to look at the track record, 25%. That is the estimated historical average annual return of Pelosi's portfolio. Think about that for a second. That's a figure that consistently beats the S&P 500. This incredibly impressive history of market-beating returns is exactly why these disclosures command so much attention from Wall Street analysts and everyday investors alike. People watch these filings like hawks because, frankly, the track record is just rock solid. Section 1. The disclosure. Separating hype from reality. But hey, before we all go blindly mirroring this portfolio, we need to look at the objective facts of the filings released in August 2026. We've got to separate the actual mechanics from the hype. These disclosures revealed purchases that were actually made back in late July. First up, a heavy investment into Intel, ranging anywhere between $250,000 and $500,000. Second, an identical dollar amount, another $250 to $500K, placed into Bloom Energy. But here is the absolute kicker, guys. This is her first ever trade in Bloom Energy. That brand new first-time edition is exactly what sparked all this massive overnight interest. However, there is a catch, and it is a critical one. The actual purchases happened in July, but the public disclosure didn't hit until August. This outlines the mechanical reality of the standard 45-day disclosure delay allowed for congressional trades. Nancy Pelosi isn't sitting there day trading. She holds for quarters, sometimes even years. But because of this delay window, by the time we as retail investors actually hear this news, the buyer's already in at a significantly lower price. Structurally speaking, you are just late to the party. Section 2. Bloom Energy, the speculative AI power play. Keeping that structural delay in the back of our minds, let's focus on the first company. We're framing this as a high-risk, high-reward bet intrinsically tied to the massive, honestly almost insatiable electricity demands of AI data centers. To understand the speculative bet, we really need to know what Bloom Energy actually makes: solid oxide fuel cells. You can think of these as on-site power generators that run on natural gas or hydrogen. And why is this so absolutely crucial right now? Well, consider this. A single ChatGPT query uses roughly 10 times the electricity of a standard Google search. AI data centers are just devouring monumental amounts of electricity, and our traditional grids are completely choking. Bloom Energy steps in to provide the always-on backup infrastructure they desperately need. But as focused learners, we always have to view this objectively, right? The bull case here is undeniably strong. Bloom has secured massive partnerships with SKENS and American Electric Power. They're seeing boosted profitability thanks to IRA tax credits, and obviously there's that soaring demand for AI data center power. However, the risk factors are equally stark. They are still not profitable on a GAAP basis. Their margins get heavily impacted by fluctuating natural gas prices, and they face some really fierce competition from traditional diesel generators and things like Tesla Megapacks. The bottom line here? This is a highly speculative energy play. It's definitely not a safe, reliable dividend stock. Section 3. Intel. The fallen giants turnaround. Now, what's really interesting about this next part is how we reframe this legacy tech company. Intel is a vastly different story. We're looking at a legacy tech company, a real fallen giant, and viewing this investment entirely as a massive turnaround bet. Intel has lost some serious market share over the years to AMD and CPUs and to Nvidia and GPUs. But let's lay out the specific strategic moves they're making right now to fight back. First up, their gaudy AI accelerators, which they're heavily positioning as a cheaper alternative to Nvidia's super highly sought-after H100 chips. Second, they have a massive war chest, $8.5 billion in CHIPS Act funding specifically earmarked to build U.S. factories. And third, their new 18A manufacturing process, which is basically their ultimate bet to regain technological leadership. They are literally building an arsenal for recovery. When you compare these valuations side by side, you'll see exactly why a value investor might be taking a really hard look at Intel right now. On one hand, Intel is sitting at a forward PE of around 30x. On the other hand, their direct competitors, Nvidia and AMD, are commanding massive forward PEs of 45x plus and 40x plus respectively. This demonstrates crystal clearly why Intel is currently viewed as the much cheaper, value-based option for those trying to get a foothold in this explosive AI chip race. But again, impartiality is key for us. The turnaround risks here are incredibly real. If there are any delays in that new 18A manufacturing process we just talked about, it could completely derail this entire recovery plan. Furthermore, competing in the AI chip race is astronomically expensive, and that's putting some severe pressure on their margins. Oh, and let's not forget, they cut their dividend in 2023, which means traditional income investors have already abandoned ship. Intel requires serious patience. We're talking a 3 to 5 year horizon here. If they fail to execute this grand plan, Intel could simply turn out to be a classic value trap. Section 4. The verdict. Should you copy her trades? All right, we're going to synthesize all this data into some practical risk management lessons. Remember, we aren't giving financial advice here. We're just building a solid framework to make sense of these high-profile market movements. Let's weigh the scales. The pros of following congressional trades like this. Well, you're tracking a solid long-term track record, you're aligning with massive macro trends in AI and infrastructure, and you're following someone who famously holds through volatility rather than panic selling. But the cons are severe. That 45-day delay structurally guarantees you are late to the game. The short-term spikes caused by these very disclosures often fade super quickly, and frankly, congressional figures have access to briefings that everyday retail investors simply do not get to see. So, the crucial point is, do not chase the news. If you look at the data and you actually believe in a thesis behind these companies, here is a methodical, structured approach to consider. Step 1. Set limit orders 5 to 10% below the current price so you aren't just buying at the absolute top of a news-driven spike. Step 2. Scale in slowly over 3 to 4 weeks instead of going all in at once. And Step 3. Treat Intel as a long-term core holding, accumulating on weakness, but only if you genuinely believe in the resurgence of U.S. manufacturing. Now, when it comes to Bloom Energy, risk management looks a little bit different. A high-risk, high-reward, non-profitable stock like Bloom should ideally represent a very small slice of your overall pie, perhaps just a 2 to 5% speculative bet. The vast majority of a prudent setup, like 95 to 98% of it, should really remain anchored in a core portfolio of diversified holdings. You definitely don't want to bet the farm on a speculative AI power play. For those of you who want a slightly less turbulent ride, let's look at a safer alternative. If you absolutely love the macro themes we discussed today, like AI data center growth and clean energy infrastructure, but you don't really want the intense stomach-dropping risk of holding single stocks, there are great alternatives. Broadly diversified exchange-traded funds like the XLK for the broader tech sector or the ICLN for clean energy offer exposure to these exact same macro themes, but with significantly lower single-stock risk. And that brings us to the ultimate question. After decoding the filings, evaluating that tricky 45-day delay, and analyzing the massive risks and rewards of both Bloom Energy's power play and Intel's turnaround, where do you actually stand? Are you buying the turnaround? Are you betting on the power play? Or are you staying far, far away from the hype entirely? Remember, never buy just because a politician did. Buy because you truly understand the thesis and you've done your own homework. I'd love to hear your logic, so let's get a discussion going on this. Keep questioning, keep learning, and I'll see you in the next explainer.